No, but that's exactly what's going on. With higher rates, it means there's less liquidity out there, which is a lot better for us. So it's all going well.
Yeah, the landscape, how would you describe it right now? I mean, so much has changed, it seems, in terms of risk assets, to say the least, since I last spoke with you.
Yeah, it really has changed. It's like the whole, and I apologize for my cold. It's a huge differential. The whole outlook is totally different. Where now people are nervous about what's happening. And because of that, it's made things for people like me a lot easier. So like on the venture debt side, we're lending money. We're lending money now anywhere between sort of 10, 15%. Whereas before it was just getting harder because you'd have private equity coming in. Everything we're doing is easier today because people need the capital because they're looking at the world differently.
How do you view where the Fed is today? I mean, do you have in your own mind what you think will be the number of rate hikes that we're going to see over the next many months, let's say in this calendar year, what you would think is appropriate and how you are sort of figuring out your own investment strategy as a result of gaming that out?
I think for us, we just know rates are going up. So the higher rates go, the better it is for us. I don't know what the Fed, how high it's going to go. But what I do know is people are nervous about that. And as they're nervous about that, what everybody needs is liquidity. And we provide that liquidity. So I think rates will go up at least 3 or 4 times. At least the Fed will do that. And for what we do, that's positive.
What seems reasonable on the 10-year, if you venture a guess? We're pushing the door on 2 at this point on the 10-year. What seems reasonable to you?
Well, reasonable would be 3 or 4. But if that happens, then again, the cost of that capital just keeps going up. So I think it'll get at least to 3. I don't know if it gets to 4.
Well, I mentioned earlier on our program these comments today from Jan Hatzius of Goldman Sachs, who I thought put forth some pretty provocative thoughts, and I wanted to revisit it with you, get your thought on it, and I'll read you part of what I read earlier, where he suggests that to get the inflation scenario under control, that, quote, growth needs to slow and financial conditions need to tighten at an earlier stage of the recovery than previously expected. That will cause an increase in riskless yields, a widening of investment grade and high yield credit spreads, and then lower expected returns and bigger equity drawdowns. I'm wondering what you think about that, first and foremost, and then if you could also tell me how closely you're watching the high yield market.
Well, we watch the high yield market pretty closely, but if you think about what he's saying, he's sort of arguing that to tame inflation, you need slower growth. I think, my own personal view is you want growth. And I think people will deal with the inflation with the growth. So I think the Fed is trying to find that middle ground. But ultimately, this isn't good for equities, right? So whether you're talking about 2% growth or you're talking about where growth is going to go down more, if everybody's focused on inflation, that's negative for equities. So that's what's going to happen. And I think you're going to find more and more people saying what he said.